Hi, everybody. I'm Nadia Khan. This is Ozzy Khan. It looks like we've got a few people joining, and I will be admitting people as they come on. Hope everybody's doing great today. Ozzy Khan and I are on the advisory board of White Rock Capital, and we wanted to go over today some strategies that Ozzy has been using and learn how to maximize return for multifamily investments.
Oh, yeah. Thanks, Nadia. And great to be here. Thank you, everybody, for joining us today.
Awesome. Ozzy, before we get started, I'm going to be asking Ozzy a couple of questions, and it's going to be an interview style webinar. So, we're going to be talking about the market strategies, some things that he's learned, where he sees the market going. We'll answer some questions at the end and open it up to the audience. You can put your questions in the chat. But before we do that, I'm going to quickly share my screen and we can go over White Rock Capital, what we're about. Oops, sorry, wrong one. And Ozzy's going to talk a little bit about the fund that he started.
Sure. Yeah. Thanks, Nadia. And welcome, everybody. Thanks for joining. White Rock Capital Income Fund, we just started primarily to focus entirely on multifamily acquisitions from this year moving forward. The market has changed tremendously, and we're at the bottom of the multifamily market right now. We're in the middle of a crash, and it's taken 15 years to get here. Normal cycles are 7 to 10 years. So we set up the fund in order to source and buy distressed multifamily deals. And just to give you a little background on myself, for the last few decades, I've been in the real estate business as well as many other businesses. I've done about $250 million in business, ranging from the car business to the furniture business to the home flipping business to property management. And of course, what we did is funneled the profits all into various real estate investments, especially multifamily and various commercial investments. From 2009 to 2019, we purchased about 150 real estate deals, commercial and residential. We purchased industrial flex space, neighborhood strip centers. We did some land deals. We did ground up construction, new construction on luxury homes, multifamily, of course, and single family condos, townhouses. We kept about 50% of that portfolio, which we still have in our portfolio today. And now we're pivoting back to multifamily entirely because the whole landscape has changed with multifamily. And we currently have LOIs out on about 300 units.
Got it. Thanks for sharing that. It's helpful for people to know what your background is. You clearly have a lot of experience investing in multifamily over the years. You've acquired and sold many different properties, many different asset classes. So, for those of you who have really specific questions, again, we can open it up at the end, and I'll be letting you know how you can get in touch with Ozzy with your specifics. So, I wanted to start today by talking about the market. So, Ozzy, because you've been doing this for so long, you've been through a lot of cycles and you've seen the trends. Can you talk to us about what has been going on in the multifamily market in the last, 10, 15 years? Give us a little history, and give us a history of what's been going on in the last couple of years and what's going on now, and how you're seeing things shift.
Sure. Yeah. So if you go back to the last crash, which was in 2008, 2009, that was a financial crisis. I'm sure everybody remembers that. This is a little different. This doesn't feel like a financial crisis because the demand didn't go away. There's tremendous rental demand. There's tremendous amount of capital on the sidelines right now waiting to invest in distressed deals. But if we go back to 2008's crash, it was a great opportunity to buy in the stock market as well as in real estate. And people started realizing that multifamily was a great place to be. So they started buying in 2008, 2009, as we did as well. And rents started to increase. So by the time we got to 2015, the word was out and publications and news platforms were boasting about the multifamily market, encouraging people to get in because it was really starting to gain momentum. And by that time, brokers weren't even advertising listing prices on multifamily. They were just saying offers are due by this time next week. So when that happens, you know that there's a ton of demand. So the demand continued from 2015 onwards. We tried to buy numerous deals from 2015 to 2018, and the brokers would say to us, well, get in line because there's 30 or 40 other investors so ahead of you. So what that tells you, that was a red light for us, and we got outbid on many multifamily deals, which was just fine. So we watched the market continue to rise. Rents kept going up. New syndicators came on the market, came on the scene, and they raised millions of dollars from LPs who really were not experienced, and these newer syndications were not very experienced as well because they hadn't been through cycles, several of the real estate cycles. So they kept bidding up these properties, and the prices went through the roof up to 2021, which was the peak. Now, by that time, Nadia, the investors were overpaying for these multifamily deals. They were over leveraging on these multifamily deals. They were not underwriting them. I remember several cases where they were putting $1 million hard money from day one deposit, which means a non-refundable deposit, and they weren't even doing the proper due diligence. Huge red flag. You know that no, experienced investors don't do that. It's just too risky. And they weren't factoring in a stress test in case the bubble bursts. Now, we saw the writing on the wall, as did a lot of professionals, and we stood on the sidelines. We were on the fence from 2020 to till now in the multifamily sector. We were busy with buying industrial flex space and other assets. We bought a medical building just a year and a half ago, turned that around. That's going great. We did some land deals and some construction and whatnot. But now is the time to get back into multifamily because the bubble did burst. And it burst in 2024, 2025, and 2026. And yeah,
And
I
I'm
think
just sharing my screen here so you can go over this chart that you have, which kind of describes what's been going on.
so. You see 2024 on the left, foreclosure filings went up to over 300,000 in 2025. You'll see on the right, the delinquency rate shot up to over 6.5%. There is approximately $2.2 trillion outstanding in multifamily debt. Approximately 800 billion of that is coming due now. They call it the debt wall or the refinancing wall. And that's what's happening right now. So basically, people who bought from 2019 to 2020, 24, 23, they were buying with what's called floating rate debt because they could get a lower interest rate. And in order for the deals to pencil out, in order for the deals to underwrite and make sense, they had to get lower rates because they kept paying higher prices. And they thought rents would continue to rise. And you
Right
can put
now,
in
you're seeing a crisis, and there's a lot of people who have overpaid who are not able to service the loans anymore. So right now, you're seeing this as an opportunity to jump in and buy some of those deals, right? So,
Absolutely, because that floating rate debt is short term. It's 3 years or 5 years. And so if you bought a property and you paid at the top of the market in 2021 and that floating rate debt is now coming due, let's say you bought at 4% and now it's up for maturity and you got to pay 8%. Factor in rents have come down 30%, values have come down, expenses have gone up, property taxes have gone up, insurance premiums have gone up, labor costs have gone up, your payroll has gone up, the cost of materials with inflation after COVID. So it's like a perfect storm to cause the multifamily market to crash. And that's exactly what happened. And that's exactly where we are and why this is the best time to get in.
so in that era where, the past 5, 7 years, prices were going up and up, rents were going up. If that's not happening anymore in this new era that we're in, where are your returns coming from? What specifically are you looking at when you're analyzing deals? And talk a little bit about returns specifically, besides rental increases.
Yeah, so those days are over where you're doing pro formas and having fantasy rental appreciation projections. That those days are gone, and the days of cheap money, those days are gone. I don't think the interest rates are coming back down to 2, 3, 4%. With the way inflation is going and the cost of doing business these days. So yeah, today it's a different landscape. You have to buy deals that pencil out with today's numbers, today's rental income, today's expenses, today's management costs, today's property taxes and insurance premiums. So as long as you can do that and you're buying in a good location, so that's the best value add you're going to do right from the get-go because the days of all of the fancy value add components of deals is way different now. It just before you could go in and put granite countertops in the unit, put some new LED lighting, new flooring, new paint, and then bump the rents up 50 or $100 a unit or even more. But today, there's so much supply on the market. There's so many options for tenants that even if you do those kinds of improvements today, you may not be able to bump the rents at all. So it's better to underwrite it based on today's expenses and the condition that the property is already in, as long as it's in good operating condition.
So instead of focusing on just small, quick fixes and increasing the rent, you're really putting the deals through a stress test. You're looking at everything with a finer tooth comb, tightening up expenses, making things more efficient, and cutting out waste, and not just relying on quick renovations. So you're analyzing these deals a lot more detailed than others were in the past. But I think that's kind of your mantra. You guys are a lot more conservative than most others in terms of the deals that you buy and the deals that come on your desk, right?
Yeah, yeah, that's exactly right, Nadia. We have to, in today's market, you have to be very careful about your expenses and what you're paying for the deals and make sure you're buying them below replacement cost. Make sure the location has a lot of in-migration. Make sure that the condition of the property doesn't need anything, major, that you can't handle. And we're looking for properties with problems. Basically, we're looking the way to add value in today's market. Number one is to have conservative leverage, have excellent management, and we'll get into that a little bit later if people have questions on that. But that's an underlying major key to the success of any deal is to have really top-notch property management. And then make sure your expenses are in line. So some people don't know how to check that. So one of the ways we check the expenses are, let's say you're looking at a deal, and what you can do is you can call a property management company who runs other properties in that market, and you can say, hey, look, I'm trying to buy a deal in this neighborhood. You guys run and operate deals here. Can you help me with the expenses to make sure they're in line? So you can go line by line, and you can see where they're paying too much for items like overnight security or utilities or trash removal or landscaping. We looked at a deal last week where they were paying double what they should be for all of those items. And if we end up buying that deal, we'll know how to cut those costs and add thousands of dollars to the monthly cash flow.
Hmm. Yeah, thanks for sharing that. That was one of my other questions were what are some things that you look at when you're trying to make a deal, trying to make a property run more efficiently. So it sounds like it's the things like expenses, utilities, management, payroll. You talk a lot about hiring the right management company so that they're not overspending. They know how to make the right decisions to keep things moving efficiently. So Obviously, if someone's done this before, they may have some management companies that they know and trust, but it depends on the location. So for you, in a city that you haven't worked in, how do you find the right management company?
Yeah, that's a key point, and that's a key issue because deals that we have bought before were entirely because the management couldn't operate it correctly. They were out of town owners, out of state owners. They didn't know how to vet the management company properly, and they weren't coming and visiting the property on a regular basis like you should to inspect what you expect to be done and verify. And management in today's market is very different than it was 10 years ago, 20 years ago, with all of the digital marketing, the SEO, the social media, the Google reviews. These are all very, very important things. And you have to have a modern management company that is on top of all of the social media. And you have to have a management company. A simple little hack is this. If you're looking at a C-class deal that you want to buy, and a friend of yours says, "Oh, I got a great management company over here who does phenomenal work on these A-class buildings." That's not the type of manager you want for a C-class property. And vice versa. If you're looking to buy an A-class deal, you don't want to hire a C-class manager to manage that because you're working with two entirely different tenant profiles and they require a different strategy. So you have to vet your management company pretty much as you're going to vet the deal itself that you're buying. So call them, talk to them, ask them what deals they manage, how much they charge, get references from owners that they manage for, physically visit the properties that the property management companies oversee. Talk to the staff, talk to the tenants. Are they happy with the management company? But an underlying key factor is what is the occupancy at that property that this company is managing. So you'll begin to see a picture who runs them well. And we have a whole 50-point checklist that we talk to the management companies about before we hire one.
Got it. Got it. Thank you. So it sounds like that's one of the main components to look at when you're analyzing a deal. Um, you talk a lot about the oversupply that we're seeing right now due to, all of these syndicators that maybe overpaid in the past few years. Why do you see that as an opportunity rather than a risk? And can you talk specifically about things that you're looking at that may mitigate the oversupply, like new construction starts, in migration, things like that?
Yeah, yeah. So that's a key issue. If you bought deals in the last few years, you're pretty nervous right now. You're basically in trouble because we've had 500,000 units, brand new constructed multifamily units hit the market in 2024 and 2025. That that's a 50-year high. So what we're going through right now is a digestion period. It's called absorption. So it could take a year, it could take 2 years for all of that product to get absorbed. It is getting absorbed quicker than we thought. So this window of opportunity to buy at the bottom of the market when the supply is at the highest may only be another, 6 to 9 months. We don't know. It could be 12 months, could be longer. But for me, I like markets that are oversupplied as long as they have good in-migration, good job growth, good new development. And so how do you find those places? Well, first of all, most of the oversupply is in the Sun Belt markets, in Florida Texas, Arizona. Um, but the good news is there's still good in migration into those areas. So one way to check that is population migration patterns. That's extremely important in the real estate business. So you got to check those population migration patterns, and one quick, easy way to do that is you can go online and check United Van Lines, for example, North American Van Lines. U-Haul is a good source, and you find out, well, how many people are moving from Boston to Nashville one way? How many people are moving from Los Angeles to Phoenix one way? And you'll begin to see a trend. And why are they moving there? Maybe there's a lot of job creation, and those are the markets you want to focus on.
Makes sense. So sounds like you do a lot of research before you jump into any deal. So you're not just looking at their numbers, you're looking at the city and the state as a whole, what's going on in the local economies to really make a more informed decision so that you can underwrite the deals so that they'll be lucrative in the future, not just in today's market.
Yeah, precisely. Because look, we're getting a lot of layoffs. You know, Amazon just announced, I don't know, 10 to 15,000 more layoffs in the US, 49,000 worldwide layoffs they're going to do. So somebody in Cleveland, Ohio, for example, I'm not singling out Cleveland, but let's say there's layoffs in a company there, and all of a sudden 300 people are out of job. They may stay there, they may not stay there, they may move. So one city is going to have a downside effect, but somewhere else is going to benefit from that. So the key is to find out which cities are benefiting from the population migration patterns.
Got it. Let's talk a little bit about interest rates. So there's a lot of investors who are waiting for rates to drop again. What is your advice to them on timing? And specifically, I know we have another chart that illustrates your point. I'll pull that up now.
Yeah. So interest rates, in my opinion, and from the opinion of top brokers, economists, and operators that I regularly converse with, I think that mortgage rates are going to stay higher for longer. They may drop a little bit, a quarter point, maybe half a point, but I think higher for longer because the Fed may drop short-term rates, but mortgage rates are not tied to short-term rates. They're tied to the 10-year Treasury yield. So in the chart that Nadia just put up, you can see the green line is the mortgage CRE loan rates, and that's kind of goes in tandem with the orange line, which is the 10-year Treasury. The short-term rates in the blue line, they're trending down, but you can see the trend is heading upwards. And that information comes from TREP, Adam, the Federal Reserve, and but the good news is even higher for longer, uh, that creates refinancing stress, which puts more pressure on the current owners that need to get out from under a problematic property, which means more opportunity for the investors.
Hmm. So your advice is to not wait.
Yeah, I've been there and before, a couple of decades ago where I thought it would be good to wait, and I had the paralysis of analysis, they call it. And I think if you do that, you're going to miss out. This is one of those moments where we're deploying capital with discipline. The disciplined investors are going to be the winners in this round of the cycle.
Hmm. So can you talk to us about how income producing real estate behaves differently than stocks?
Yeah, I'm not against stocks, but now's not the time to buy stocks, in my opinion, unless you're an expert and you are a full-time stock investor and really know what you're doing. For most of us, um, real estate is a much better long-term investment and cash flowing investment than stocks. There's monthly operating income driven by occupancy and rents versus stocks where there's quarterly discretionary dividends which are dependent on market conditions, which can change rapidly. With real estate, you have tax depreciation, you have tax deferral. And in America, we've got one of the greatest real estate tax deferral 1031 exchange rules, which I can explain later. In stocks, you're taxed on your dividends, you're taxed on your realized gains. If you need cash and you need to sell that stock, you're going to be taxed. Real estate, you can transfer the money without paying tax. And again, I'll explain that later. The volatility is lower with real estate. This crash didn't happen overnight. It took years. Volatility in stocks, it can happen overnight, as we all know. You can lose everything in one day, which we've seen before, because the market is sentiment driven. And it has very, very high volatility. With real estate, you have long-term durability, capital preservation, equity growth. You have liquidity with stocks, but you've got much higher exposure and higher risk, in my opinion.
Got
Oh,
it.
and by the way, sorry, Nadia, I just saw this yesterday, and this is not me saying this is MetLife, one of the largest insurance companies in the world. MetLife Investment Management reports that commercial real estate valuations based on cap rates relative to stock PE ratios have fallen below equities for the first time in roughly 2 decades. So that's another supportive argument why you should be focused on multifamily real estate right now as opposed to the stock market. You buy stocks when it crashes. You buy on the dip. Right now, in multifamily, this is not a dip. This is a major crash.
Mm-hmm. Got it. Got it. So, um, we talked previously about how to make the properties more efficient in terms of, the way you operate, like hiring the right management company and cutting out waste. But what about certain rising costs, like rising insurance premiums, rising taxes? A lot of areas have seen premiums go through the roof. How do you protect your investor returns against those rising costs?
Yeah, rising costs is what killed a lot of deals, and it's the straw that broke the camel's back on a lot of deals in 2022, 2023. See, when interest rates went up, it was really the later half of 2022 when interest rates went up. And that's when the things started to break down. That's when stress entered the system. That's when the cracks started to show. And because rents had come down, values had come down, expenses skyrocketed with insurance and taxes, and these and not to mention the oversupply. So those deals started to deteriorate from 2022 right up till now. So now we are seeing a little bit of relief. I remember paying $1,800 a door per year for insurance premiums. I was talking to a friend of mine in Florida who buys multifamily. $3,000 a door they were paying last year. When 5 years earlier they were paying 500 to $1,000 a door. Now that's a bit of an extreme example because Florida has much higher premiums than most of the rest of the country due to the tornadoes and proximity to the oceans. So the way to mitigate that now moving forward is you need to appeal your property taxes every year. We use a company who does that for us every year. We save thousands every year, and the tax attorneys know how to do that. And as far as insurance premiums go, luckily we're getting some relief with insurance premiums. They have come down, but what needs to be done moving forward to keep that under control, Nadia? There's no way to guarantee premiums are not going to go up. So when you're underwriting, you have to stress test. You have to add a little bit extra into your expenses to account for premiums increasing next year and the year after and the year after in your pro forma. And the same goes with property taxes. Some expenses you will be able to lower. However, you need to stress test also in case rents drop. Somebody asked me yesterday, well, are we at the bottom? I think we're at the bottom in a lot of markets, but there may be some markets that haven't hit bottom yet. And that's the real question here. Are we at the bottom or are rents still going down? So if you're not sure and you're getting mixed signals in the market where you want to buy, stress test the deal and underwrite for rents dropping a little bit more this year and next year, maybe 5%, 10%. So as long as you stress test, you add for increased expenses and you underwrite based on today's rents, realistic expectations, realistic projections, realistic, pro forma, and conservative Fannie Mae, Freddie Mac financing, standard agency financing. Here's an important key now. Get long-term fixed rate debt. Don't go for short-term floating rates. That'll kill you if the market has huge fluctuations. I want to know what my mortgage payment is going to be next month, next year, and 5 years from now. So we're going for a 7 to 10 year fixed rate debt. Now, there's no guarantees that you're not going to have problems, with expenses or operations. We all know things happen. But to really minimize those things, go for the things I just mentioned.
Yeah, that was my next question. So, it sounds like, just to recap, you're saying, put the deals through an extreme stress test. Don't assume increasing rental rates year over year. In fact, maybe incorporate them going down or at least staying the same to be really conservative to kind of offset rising costs. Um, if anyone has any specific questions about other ways you can lower expenses, and you can ask Ozzy at the end. But my other question was about the short-term bridge debt. It sounds like you think that's not a good idea. You prefer fixed rates and you prefer holding deals long term.
Yeah, absolutely. Um, I read a book about 15 years ago about 20 billionaires. There was 20 chapters in the book, each one on one of these billionaires who made 90% of their wealth in real estate. Every single one of them had one thing, one underlying common denominator in their modus operandi, which was to buy real estate, hold it, never sell it. If you need to raise cash, do a cash out refi. Keep that real estate, make sure it's well run, well managed, and it will feed you and your family, your investors, your future generations for generations to come. I can give you small examples. Nadia, 30 years ago, we bought a warehouse, a little warehouse for $300,000. We were storing construction equipment in there. And I could sell it for over $2 million today. We rented it out for 10 years. The tenants paid off the mortgage. The cash flow from it now is an infinite return. We bought another warehouse deal for 2.5 million about 20 years ago. We could sell that for 12 million today. This is completely, the tenants paid everything off. I mean, what kind of return is that now? How do you measure it? 1,000%, 1,000,000%? Is an infinitesimal return. A multifamily deal we bought 18 years ago. We paid $3.5 million for it. We've already done one cash out refi on it. I've had offers north of $21 million on that deal. We paid $3.5 million for it. So I'm a big proponent of holding real estate for the long term. And that's how these family offices have built hundreds of millions, billions of dollars in generational wealth by holding good quality real estate, managing it well, and holding it for the long run.
Mhm. Yeah, that's a helpful tip. And I think for those of you who don't know who we are focused on long-term investments, more conservative investments. So, in terms of the properties that you're looking at now, all the deals you're analyzing, are you focusing on Class A, B, or C, and why?
hmm Yeah. Before we never looked at A because the cap rates were too low. They're too fancy. They attract institutional investors who have very deep pockets. They tend to pay higher prices for nice, shiny, beautiful buildings, which I understand keeps their investors happy. And if their investors are receiving a 5% return, preferred return, they're happy with those beautiful buildings. The landscape has changed right now. There's so much overbuilding with Class A. I was talking to my broker in Phoenix the other day, and there's a lot of A-class deals you can buy over there at 20, 30% below replacement cost. It's a renter's market. The rents are down. A lot of these properties aren't able to meet their debt service, so they're in trouble, and that's why they're selling below replacement cost. But on the other side of it, they're offering 1, 2, 3, as much as 4 months rent free. So that has to be factored into your underwriting to make sure you understand how you're going to burn off those concessions, how long it's going to take to burn off those concessions so that the deal becomes profitable. So we are looking at some A class, but I'll tell you where I think the sweet spot is. In my opinion, the sweet spot is C plus class to B plus class. An example, in Austin, we looked at a deal recently, A class deal, they wanted to sell it at a 5 cap. There's a B class deal down the street. It's only 8 years older, but we can buy it at a 6 to a 6.5 cap. That's a significant price difference for an asset that's only 7 years older. So I would rather go for the B plus asset and pay less money, get a higher cap rate, and you're still getting a beautiful product rather than pay the higher premium for A class. unless you're really getting a substantial fire sale on the A class. So I think the sweet spot is between C plus and B plus.
Okay, that makes sense. But regardless, it sounds like for those who wanted A class, now is the time to get them because you're seeing more A class properties hit the market than ever before.
Yes, absolutely. Yeah, we're definitely looking at all three classes. And whatever comes up to pencil out the best, that's what we will go after.
Got it. So if rates stay higher as you're predicting, and this is kind of the new norm, how do you expect to turn a profit in the next 5 to 7 or 5 to 10 years? Or are you going to be holding most of these properties long term?
Yeah, I think the profits are definitely going to show up between the next 3 to 5 to 7 to 10 years. Our normal hold period is 5 to 10 years, and a lot of the deals we still own today, decades later, some of the investors wanted to be bought out at the end of the deal cycle, which was perfectly fine with us. We bought them out, everybody's happy, and we continued to hang on to those deals because long term, the magic of compounding and the magic of rents increasing and equity increase capital appreciation is phenomenal. So from today onwards in this new environment, we are looking at the same kind of structure long term, but because we're buying at the bottom of the market, you're going to have an opportunity to have built-in equity over, if in as opposed to waiting and buying in 2 or 3 years from now, because I think all of the oversupply will be absorbed within the next couple of years. And then what happens is once all that supply is absorbed, rents start increasing again. That's when the values start going up again. But if you wait till everybody piles into the market in a few years from now, which is usually what happens, you're going to miss out on a huge amount of equity that you could have had if you get in now.
Gotcha. So even if rates stay elevated or move upwards, you're analyzing these deals to make sure, again, you're putting them through a stress test. You're making sure they pencil out now and in several years. And for all the reasons you described, like the in-migration, making things more efficient. Is that right?
Yeah, yeah, exactly. Underwrite your deal based on the cost of financing today,
Mhm.
the cost of your expenses today, the cost of management today, the cost of, all your taxes, insurance, everything, and what realistically can these units rent for today? What can you underwrite it at so it's going to be durable, predictable income? We personally are not underwriting any rental increases this year or next year. You can put anything you want in a business plan, but as we've seen in the last 5 years, it doesn't always work out. So if you invest with White Rock Capital or somebody else, ask them what their business plan is. If they're telling you we're going to have massive rental increases next year, I would be very skeptical and walk away from that deal. Ask them how they're underwriting. Ask them why they chose that property, why that market, why that particular deal, what condition is it, how much CapEx are you going to need to put into the deal, how much are you paying for financing, and who are you going to get to manage this property, and why should I invest in this property? What is your analysis? What are your expectations? Very, very important to ask all of these questions and compare different people you want to work with and narrow it down to the most experienced, most seasoned sponsors who have been through the crashes.
That's very helpful. Um, I have one more question. It's about the tax realities, or sorry, after tax reality, after if you're comparing multifamily investments versus CDs or money market accounts, what is the difference? And in your opinion, do you think multifamily investing is better or real estate investment is better after tax?
Well, in a high interest rate market like we're in and high inflation market like we're in, the best place to be is in solid income producing assets. not in cash. Now, if you have money in a money market because you're keeping your powder dry, waiting for a great deal, that's understandable. We're doing the same thing. But if you look at it and you're getting 4% in a money market, one and a half percent or whatever goes to taxes, the rest gets eaten up by inflation. So you're at a net negative. Your cash is getting devalued, it's getting eaten away. Cash is the wrong place to save for the long term. The US government is printing more money every day. It's devaluing the currency. That's why people are going into Bitcoin and gold and silver and real estate. Gold is not worth $5,000 an ounce because something magical happened to gold overnight. It's because the US dollar is getting devalued. So how do you prevent your dollar from getting devalued? You invest it in solid assets that appreciate when inflation appreciates. Real estate goes up if the market, when inflation comes into play. So it also gives you cash flow every month, durable, predictable cash flow if you invest correctly with the right people. Now, if you want to do this on your own, which you can very well do, I started out doing it on my own, and that's when most of the mistakes were made early on in my career. Once I started partnering with people who were seasoned investors and operators, that's when the returns skyrocketed because you've got to surround yourself with people who have been through the ups and downs of the cycles. You need to know how to position your deal, how to capitalize it, how to fund it, how to finance it so that it can withstand the bumps in the road, so it can withstand the market cycles. It can, there's going to be times when there's going to be rents are going to drop, or you're going to have to replace the management company, or you're going to have employees that you need to be replaced, and it's going to cause a disruption in your operation. So you have to factor in all of these things, and it's important, in my opinion, if you're somebody new to real estate investing, to make sure you invest with somebody who's a seasoned operator and a seasoned GP and sponsor.
Yeah, I agree with that 100%. It's a big risk, and you need to make sure you're analyzing the deal property. And there's so many different types of things to look at. There's so many components, so many things that could go wrong. So you want to make sure you're working with the right person. And if you're doing it on your own, starting small, as you've recommended before. So, I hope that was helpful in giving some tips to everybody on the call. I wanted to open it up for questions. So if people have a question, you can type it in the chat. Here's one. Well, Brian, first, thank you for pointing out the tax tip, cost segregation. I'm not an expert on that, and so I can't really speak to the details, but I am familiar somewhat. Um, and then Samia, which cities are you seeing the best opportunities for multifamily acquisitions? You mentioned Phoenix is one.
Yeah, so we're looking at the markets that are generally oversupplied. That's where you're going to get your best opportunities. So where is the oversupply? The oversupply is mostly in the Sun Belt markets: Houston, Dallas, Austin, San Antonio, pretty much all of Florida, Broward County, Miami-Dade County, Orlando, Nashville, Memphis, Atlanta. Uh, Las Vegas is way overbuilt. Phoenix is overbuilt. There's a lot of opportunities in a lot of these Sun Belt markets, and it's not that the entire country is in distress with multifamily. Some markets did not have the peaks and the troughs like the Midwest, parts of Ohio. But those are steady Eddie markets. You can do very well over there, but they don't have the high peaks and troughs. So we're looking at the oversupplied markets as long as they have good in-migration. And the Sunbelt areas do still have very good in-migration of people moving there because there's still a lot of job growth in these markets. So that's what we're focusing on. The Carolinas are good too, by the way.
Got it.
It's still expensive, but that's a good place.
Thank you. Um, do you invest yourself in all the deals that you acquire?
Yeah, so a friend of mine the other day asked me, and I'm not sure if Anna is on the call or not, but she asked me about a self-storage deal in Virginia. I won't mention the city, but the long and the short of it is that the sponsor, the syndicator, was not putting in any of their own money. They had no skin in the deal. So that was the first red flag, and I suggested she walk away from the deal. Those days are over where syndicators would raise all of the money from the LPs and not have to put a nickel into the deal. Those days are over. We invest in every single deal we offer. We have skin in the game on every single deal. We have confidence in every deal we buy, and we will invest alongside the LPs in every deal. Sometimes we'll invest 5, 10, 20, as much. We've put as much as 50% in deals. So yes, we'll be in every deal.
Gotcha. Okay, that's really important. I think that hopefully would give people confidence that you're putting your own money in the game. So you're putting your money where your mouth is. You're analyzing these deals, not just for other people, but for yourself as well.
Yeah, and also we never buy deals with negative leverage. Only buy deals with positive leverage. Because if you're buying a deal at a six cap, that's a 6% return. So if something goes sideways or upside down or if rents drop, that's not much of a cushion there, especially if it's already fully occupied. You don't have room to add value to it. So we look for deals that are problematic where we can add some value to it. And only if it has positive cash flow from day one. Remember, guys, cash is no longer king. Cash flow is king. And cash flow is your oxygen. You run out of oxygen, you're dead. So only buy deals with positive leverage from day one, based on trailing 12, current income.
Got it. Brian wrote GP fees and expenses. Um, could you elaborate a little bit, Brian? I'm not sure exactly what you mean.
Yeah, Brian, if you want to unmute, I know Brian. Brian will probably be able to explain that more than I. Or if Shums is still on. Oh, Shums, are you still on? Do you want to chime in with that one for Brian?
It's just my end of it. Can you hear me, everybody? Can I be heard?
Yes.
Yep.
Okay, my end of that is, and I actually have a lot of respect for Aziz. So I'm keeping this with a big grin. But most syndications, there's a lot of different general partner fees, management fees, associated fees, and they tend to skim off the top. So it was more of a poke at you just to see how you'd answer it, not a question of integrity. I will give you an unsolicited thumbs up, okay? Because yes, I have dealt with you in the past, so that was what I meant by it.
Okay, great. No, I appreciate the question, Brian. And Brian's a very experienced investor, and I appreciate him taking the time to be on the call. So that's a really good point you brought up because one of the reasons syndicators back from 2019 to 2022 were pushing so hard to get those deals where there was 30 of them in line to bid up the price. It basically turned into an auction, is because they were collecting very large acquisition fees. And our structure is going to be different. We're going to be taking minimal acquisition fees. We're going to be taking a small asset management fee, and then when we do a cash out refi, all of that gets shared with the 70% to the LPs. When we sell it, 70% of the profit, gets split among the LPs, the 30% to the GP, which is pretty standard. And but here's the other thing I wanted to mention about the 1031 exchange program. At the end of the deal cycle, we don't have to sell the deal. If some of the investors want to be cashed out, we will cash them out. That's not a problem if we want to keep the deal. And if we want to raise capital or sell this property, we can sell it and put the money into another property completely tax deferred, which we've done numerous times on numerous deals. So you can refinance millions of dollars out of a multifamily deal and take that money and use it to buy another deal. So that's another tax advantage of real estate.
Okay. Thank you. Does anyone have other questions? Okay, I don't see
How
any other.
how about how about other prop? Sorry,
Go
sorry.
ahead. No, go
How about
ahead.
other? I didn't feel like typing anymore. How about other property classes? Right now you're focused on multifamily. Does that exclude you looking at other property classes, or are you just feeling that this is the path to go right now?
Yeah, yeah, good question because we do look at other asset classes as well. And we just looked at a flex warehouse space recently in Chantilly, and we bought a medical building a year and a half ago in foreclosure in Alexandria, and it was complete.
You bought that.
I bought that. I bought
I
that
couldn't.
deal.
I know what building that is. Okay.
Yeah, it was completely flooded. It was a foreclosure. We bought it at an extremely low basis. We put $500,000 into the renovation. We signed the last few leases. We've got great long-term tenants in there, including daycare centers, physical therapists, etc. It's already pumping out an 8% return. Next year will be closer to 8.5. And here's the kicker, Brian. We and just by buying it cheap, renovating it, filling it up, we added over $1 million worth of equity in under 12 months.
Yeah, I know the building. I was curious who bought it, and I saw what was done with it. So
Yeah.
I track a lot. I still track a lot of real estate. So
Oh, I know you do. I know you do. And I'm looking forward to doing a deal with you, my friend. We're interested in shopping plazas. We're interested in warehouse deals. We're interested. I know you own mobile home parks.
now
Um,
I got rid of mobile home parks. I've got a couple data center operations in the works, and I'm looking to build an assisted living facility that's going to lead to a template to build a half a dozen of them. So I want to talk to somebody about that. So
Well, Daniel just wrote, how do you feel about senior housing opportunities?
yeah, that was Daniel. Good because I just linked in on him. Um, yeah, I have a very strong opinion on that, and I also have a project I'm in the middle of in Triangle, near Quantico. We're going to go through the entitled process within the next couple of weeks, actually. Um, yeah, I have a very positive opinion on that, and then I'm bringing something unique to the table that I'm not necessarily. I know you've looked at it before, Z, but I've got something that you might be interested in.
Cool. Well, yeah, let's get together and let's talk about it. I know that the population is aging, it's growing older, there's a higher demand. We're looking at some medical buildings in Florida, as a matter of fact. We're trying to find locations that are close to large hospital hubs. And so yeah, that's Daniel, that's a great market to pursue for sure.
So, how would you go about doing your research on a senior housing opportunity?
Demographics.
Yeah, I'll let Brian take that one.
That's a demographic study. And it's also knowing who the operators are going to be. Each operator has a different focus on what they're looking for, and it's also varying levels. So there's senior living, assisted living, skilled nursing, memory care, but then some of the other componental parts are physical therapy and mental health. So now how are you going to tie those functions into it? It really becomes a demographic market, and then it's not so much it's not so much building or developing the assisted living facility. It's who's going to operate it. And that's really the challenge I have right now. I have something I am working on. It's pretty cool. Uh, but I'm having trouble finding a proper operator because they get into niches. The different operators have niches that they focus on. And as they'll word it, they're uncomfortable stepping out of that niche. So that's just it's look, it's multifamily is in a niche right now. Office buildings, if you can find the right deal, great. It really doesn't matter. The reason why I was teasing about property classes, a real estate deal is only as good as the real estate deal is. So if you get enough data and you know enough information and you buy it right, then you have it. I
Well,
was pretty much in agreement with everything you were saying on multifamily. Pretty much. I could have argued, but pretty much.
yeah, I think that's good points because whatever business you're in, it really boils down to the management. I mean, does McDonald's have a better product than, the steakhouse down the street, or a high-end restaurant? No, but they have management that has been perfected. They have marketing that's been perfected. So you could have a product that is not as good as the guy's product across the street, but your sales could be 10 times higher because you have better management, you have better, systems in place and better marketing. And it's the same with multifamily, and it's the same with the assisted living facilities. Like, the example earlier, you don't want to hire an A-class property manager for multifamily to run a C-class asset. What you were saying about specific niches, that's extremely important. You've got to find the right property management, and it takes a lot of vetting, and you've got to interview them and check their references and check properties that they're currently managing and contact the owners of those properties to see if they're happy with that manager's performance.
Again, I'll give you another unsolicited plug. And I'm as mean to him as I'm nice, but that's always been your strength. You really do. You look at that management component and give it the weight it's due for any project. So that's God, do something so I can yell at you and prove that I'm not a nice guy because I don't want to be a nice guy.
You're a sweetheart under it all there,
Uh,
Brian.
Brian was not paid to be here, everybody.
no, I was not, and as he knows that I've also not I'm pretty hardball on some things. Okay,
Oh yeah.
um,
Oh yeah. He challenges me. He challenged me, and I like that. That's why
so
I like Ryan. And he knows what he's talking about. Do we have any other
thank you.
questions from any other people? Because I want to be respectful of everybody's time. It's getting close to the hour here. And if there's no other questions, maybe we can wrap it up.
There's no other questions. I put Ozzy's LinkedIn in the chat. You can reach out to him directly. He'd be happy to chat with you if you have questions about specific deals you're looking at, if you want to partner with White Rock Capital, if you're interested in learning more, definitely reach out. He'd be happy to help. Thank you, everybody, for joining. Thank you, Brian, for all the questions. Daniel, thank you for your questions too. I hope everybody learned a lot. And the meeting will be recorded and sent out.
Yeah, I want to thank everybody for attending, and I'd love to connect with you. Reach out, let's set up a call if you're interested. I'd love to hear your story, hear what your goals are, hear why you want to invest in real estate, what you think real estate investing will do for you, and what you're trying to achieve. And let's see if I can help you with anything. So thanks again, everybody. Appreciate all your time.
Thanks, everybody. Have a great day.